Good afternoon. The Federal Open Market Committee concluded its last meeting of the year earlier today. Why did we update our guidance? The reason is that with the asset purchase program having been wound down in October, it seemed less helpful to continue to communicate about the possible timing of our first rate increase with reference to an event that is receding into the past. Instead, we have shifted to language that better reflects the committee's focus on the economic conditions that would make liftoff appropriate. Employment is rising at a healthy rate, and the U.S. economy is strengthening, reflecting in part a highly accommodative stance of monetary policy. At some point, it will become appropriate to begin reducing policy accommodation. Assuming that the economy evolves broadly in line with participants' expectations, almost all participants believe that it will be appropriate to begin raising the target range for the federal funds rate in 2015. By late 2016, the median projection for the federal funds rate at 2.5% remains more than a percentage point below the longer-run value of 3.75% or so projected by most participants. FOMC participants provide a number of explanations for the federal funds rate running below its normal level for longer-run level at that time, in particular the residual effects of the financial crisis, which are likely to continue to constrain household spending and constrain credit availability for some time. But as these factors dissipate further, most participants expect the federal funds rate to move close to its longer-run normal level by the end of 2017. Thank you, and I'll be happy to take your questions.
Now that Fed Chair Yellen has defined where the Federal Reserve believes the Fed funds rate should be and when, let's translate her expectations into net trading profit or loss. Directly below the video display, you'll find a link to an interactive risk-reward spreadsheet. Please right-click on this link and open the spreadsheet, which should take no more than 4 seconds. Once the spreadsheet is open, enable editing. In cell B2, you'll find the current rate of 0.10%. You can change this to any rate you'd like, and the net profit or loss will show in cell D2. In this case, $2,083, net of all bid-ask spreads, brokerage, clearing, and regulatory fees. The start balance can be changed to any amount, in this case $100,000. For the mini program, you'd use $10,000. The net liquidating value will show in cell E2, in this case $99,792. In cell E15, I've shown the initial short position at $99.90. To convert the contract price into the rate it represents, take 100, subtract the contract price, in this case 99.90, equals a rate of 0.10. Our initial number of positions is 50, which is shown in cell E16. In order to trade this rate higher, you need to establish a net short position. A contract price of 100 represents a rate of 0. A contract price of $99.90 represents a rate of 0.10. As this rate rises, the contract price falls with the position increasing in value. On this chart, in the first vertical column to the left, you'll see the rate, followed by the price, and finally the position value. Currently, we're short 50 contracts at $99.90. representing a rate of 0.10 with a total position value of $20,833. Each 0.01 change in price equals $2,083. Let's experiment with some of the potential outcomes for this trade. Using the spreadsheet, enter 0 in cell B2. The net loss will show in cell D2 of $22,917. Liquidation value in E2 of $77,083. We've posted nearly 5 times the total position value, negating any possibility of a margin call or a debit balance. We're trading futures, not options, so there was no time decay. At zero, we still have excess margin of $69,083. Next, let's assume the Federal Reserve never raises rates, and the Fed funds rate stays within the current defined range of 0 to 0.25. Enter 0.25 in cell B2. The net profit will show in cell D2 of $29,167. Net liquidating value, $129,167. Next, let's be optimistic and say the Fed is half right about achieving 1.1250% by the end of 2015. Enter 0.5625 in cell B2. The net profit will show in cell D2 of $94,271. Net liquidating value, $194,271 in cell E2. Let's go back to zero for a moment. Enter zero in cell B2. The net loss should be $22,917. Net liquidation value in E2 of $77,083. The way this trade is structured, we're not only prepared for a move to zero, but would put a move to zero to work directly for us. Enter 50 in cell E18. E20, E22, and 24 will fill in automatically. On the way down to zero, we've added an additional 200 contracts. We now have a total of 250 positions on, which will show in cell G21, and have lowered our overall average entry to 0.05%, which will show in cell G19. At zero, with a total of 250 positions on, our net loss would be $62,500, shown in cell D2. Our net liquidation value, $37,500, shown in cell E2. Now let's look at the upside for this same trade. Let's assume the market recovers from zero back to our initial entry price of 0.10. Enter 0.10 in cell B2. Our net profit will be $41,667, shown in cell D2. Net liquidation value, $141,667, shown in cell E2. Now let's enter 0.25 in cell B2, representing the top end of the Fed's current target range of 0.25%. The net profit will show in cell D2 of $197,917. Net liquidation value shown in cell E2, $297,917. Now let's use 0.5625%, representing half the move to the Fed's target for the Fed funds rate of 1.1250 by the end of 2015. Enter 0.5625 in cell B2. The net profit of $523,438 will show in cell D2. Net liquidation value, $623,438, shown in cell E2. My objective between now and the end of 2017 is to generate a net profit equivalent to half of the move to the Fed's target for the Fed funds rate of 3.75 by the end of 2017. Enter 1.8750 in cell B2. The net profit of $1,890,625 will show in cell D2. The net liquidation value of $1,990,625 will show in cell E2. Incentive-based trading advisors and investors have a common goal: to find the markets with the highest return on risk that have the highest probability of generating a major market move. If your income was dependent on 10% of the net new high profits, what would you put your customers in? A market like the S&P that's near its all-time high at 2,058, hoping for a higher high of 2675 for an appreciation in contract value of 30%, or the Fed funds rate moving from the current 0.10 to 0.13% for the same 30% appreciation in contract value. Facts. From near zero, Fed funds can only have a major market move in one direction, higher, as one member bank is not about to pay another member bank to borrow from it, which would be required in order for the Fed funds rate to go negative. The Fed, who sets this rate, has clearly defined where they see this rate and when. They posted it on their website, and they update us at every FOMC meeting. The market's not priced in this move, but will very quickly when the Fed ignites the move higher with either a statement of tightening or an actual hike. Fed funds aren't the only market that's set up for a major market move. Bunds, Japanese government bonds, stock indices in all countries, energies, metals, currencies, all have been impacted by the tough decisions our global financial leaders have made and will have to make over the next several years. For an additional 64 strategies out of the several hundred we track and trade, see link number 6. If you'd like additional information for any U.S. market we trade on link 7, any Eurex market we trade on link number 8, any Euronext market on link number 9, call me on 949-302-9652 or respond to this email with your contact details, markets, and strategies of interest. If you'd like to review how balances are guaranteed plus or minus trading activity, the clearing and exchange members we trade through, and my career history, see link number 10.